I'm buying Spotify stock right now, and I'm about to tell you why there's huge upside. We'll explore Spotify's business model, moat, and fundamentals. We'll also discuss Spotify's stock's investment risks and valuation towards the end. As of today, I own $250 worth of Spotify stock in my eToro portfolio. Once I'm done building my Spotify position, I'll own $500 worth of Spotify stock, making up 5% of my $10,000 portfolio. So what does Spotify actually do, and how do they make money? Spotify is an audio streaming platform that monetizes attention in two ways: paid subscriptions and advertising. Premium subscriptions generate the vast majority of revenue, around 88% of it, while the free tier acts as a funnel to convert users into paying customers. This is known as the freemium model. The freemium model works by giving away basic services to build a relationship with the customer and then upselling advanced features, storage, or ad-free experiences. It's especially effective for software-based businesses with low marginal costs and high lifetime value. Marginal cost is the cost of producing one additional unit of a good or service. Companies like Amazon, Uber, and Duolingo all use elements of the freemium model in their businesses. Spotify is the largest global player in music streaming with an estimated 32% market share and 713 million monthly active users. So how does Spotify defend its leading market position against competitors like Apple, Amazon, and YouTube? Spotify's most notable competitive advantage is its network effect. A network effect occurs when a product becomes more valuable as more people use it. Spotify's network effect comes from the way every additional user, playlist, artist, and piece of listening data makes the platform more valuable for everyone. As more people join, Spotify's recommendations improve, social sharing becomes more frequent, and creators gain more reach. With 713 million monthly active users, Spotify has become the go-to platform for up-and-coming artists. If you're an up-and-coming artist in today's digital and globalized world, you have to be on Spotify to have the best chance of being discovered by new listeners. Spotify also benefits from high switching costs. As a Spotify user, your playlists, history, and recommendations don't easily transfer to other music streaming services like Apple Music. Switching means you'll have to start again from scratch. Inconvenience is not usually something the average consumer looks for. All this leads to my main thesis, which is pricing power. I believe Spotify benefits from much stronger pricing power than most other investors. Pricing power is a company's ability to raise prices without losing customers. When a business has strong pricing power, it means demand for its product is resilient. People stick around even when it becomes more expensive. It's one of the clearest signs of a durable competitive advantage. So how does a commodity like music streaming subscription benefit from pricing power? If they raise prices too high, users will just switch to Apple, Amazon, or YouTube, right? This is a misconception. The reality is that consumers aren't going to switch to save a couple of dollars a month. The switching costs are just too high. Spotify has raised prices at a rate of 9.5% per year since 2023, well above the rate of inflation, while experiencing little customer churn. Churn is the rate at which customers cancel their subscription. These price increases have coincided with explosive free cash flow growth, going from basically break even in 2023 to $3.4 billion in the last 12 months. And the industry dynamics will allow this to continue because the other major players like Apple, Amazon, and YouTube don't rely on music streaming to make money. It's an add-on to strengthen their ecosystems. Therefore, when Spotify raises prices, everyone else also raises prices. Then the question becomes, what if everybody just stopped listening to music? Consumers are not going to give up their music streaming habits just because the subscription got a little bit more expensive. Users listen to music in the gym, on the way to work, while they cook, while they work, and before bed. Music streaming is ingrained in their daily routines. This is the same reason Netflix can raise prices repeatedly. Now let's look at Spotify stock's fundamentals. As you can see on the chart, Spotify's largest expense is research and development. Research and development is the set of systematic activities companies undertake to innovate, create new products, and improve existing ones. Spotify uses R&D as the technological engine behind everything in the app, from recommendations to audio intelligence, investing over $1.7 billion in R&D in the last 12 months. However, R&D isn't actually Spotify's largest expense. That would be royalties. Spotify paid over $10 billion in royalties in 2024, the biggest payout in music industry history. These payments go to the rights holders like labels, publishers, and distributors, but not directly to the artists. These royalties scale with Spotify's revenue, meaning the more Spotify earns, the more it must pay out. This is why Spotify's gross margins historically hovered around 25% before price increases boosted them above 30%. Royalties keep the cost of revenue high. However, as Spotify's scale increases, its leverage in negotiating with rights holders also grows. When Spotify launched, it had no leverage. Labels dictated terms and demanded high royalty rates and even equity stakes. Today, Spotify is no longer a price taker, it's become the platform that labels rely on to get their artists out there. Spotify flipped the script on the labels, and I think we'll see them negotiate more favourable deals, leading to higher gross margins over time. Now let's explore the risks of investing in Spotify today. Spotify's visionary founder and CEO, Daniel Ek, is stepping down. The leadership transition introduces real investment risks, mainly around execution, governance, and the loss of a singular, founder-led vision. Even though the succession is orderly and the incoming co-CEOs are long-tenured insiders, companies often stumble when visionary founders step back, and Spotify is not immune to that pattern. Ek has been the strategic architect of Spotify since day one. His instincts shaped Spotify's product, culture, and long-term bets. Replacing a founder-operator with a committee-style leadership team can dilute clarity and speed. Even though Ek remains executive chairman, the day-to-day decision-making shifts to others, and that's a real risk. However, Ek's new role of executive chairman means he'll be retaining significant influence over strategy and capital allocation, which I see as a silver lining. Now let's take a look at Spotify's current valuation to show you why I think the stock is a buy today. As you can see from the chart, Spotify's stock price has fell over 20% in the last 6 months to $550 per share. This is around the same price it was trading at in March 2025, over 9 months ago. This declining stock price has occurred whilst the company's fundamentals were improving. I think the stock price decline reflects the market's fear around Spotify's leadership transition. However, I think this is a short-term risk that will be forgotten over time as the company continues to improve. You might look at Spotify's 70 times trailing PE ratio and think it's still overvalued. However, this number is backward looking. As investors, what we should be looking at is the company's forward PE ratio at 38 times, which is still high, but the number falls again to 31 times if you look out to 2027's earnings. The PE ratio lowering over time is based on analyst expectations that the company will continue to grow earnings. If we look at Spotify's free cash flow yield, which tells you how much free cash flow the company generates relative to its market value, this number is increasing, which means the stock is becoming cheaper. This increase mainly reflects Spotify's explosive free cash flow growth over the past 3 years. I believe the stock will trade at around a 2 to 3% free cash flow yield long term. If we switch over to the DCF calculator on Qualtrim, we can input our assumed 3% free cash flow yield. Then we have to come up with an estimate for free cash flow per share growth over the next 5 years. The explosion in free cash flow per share over the past 3 years makes it seem slightly more unpredictable to estimate. However, due to continued user growth, price increases, and the use of its massive $10 billion cash balance to buy back shares, I think we can safely assume a 5-year free cash flow per share growth around 20%. With a 3% free cash flow yield and a 20% free cash flow per share growth rate, we could see the stock grow at 20% per year if bought at today's price of around $550 per share. This is market-beating performance. In this scenario, Spotify stock could reach $1,400 per share in 2031. If you enjoyed this video, click the next one for more.